Most people think professional investors win because they use complex strategies, advanced charts, secret indicators, constant trading. It looks like a world of hidden knowledge, like there's a secret language only experts understand. But here's the reality that surprises almost everyone. Most professionals don't win by being clever, they win by being efficient. And one of their favorite tools is something most beginners overlook completely: ETFs. ETFs sound boring, and that's exactly why they're powerful. They don't promise quick riches, they don't come with dramatic stories, they don't dominate headlines, you don't hear people bragging about them at parties, and professionals love them because boring works. In investing, excitement is often expensive. Boring is usually what compounds. So, what is an ETF really? ETF stands for Exchange Traded Fund. But don't let the word fund scare you. An ETF is simply a basket, a single product that holds many assets at once. Instead of buying one company, you buy a collection of companies in one purchase. One click, one transaction, and you suddenly own a slice of dozens, hundreds, or even thousands of businesses. That's it. No magic, no secret. Just a structure designed to give you broad exposure efficiently. And that structure solves one of the biggest problems in investing: concentration risk. Owning one company is risky. Even good companies fail. Even strong businesses stumble. Even market leaders can collapse through bad management, competition, regulation, scandals, disruption, or simple bad luck. A single stock can drop 30%, 50%, or 90% and never recover. That's not rare. It happens more than people want to admit. ETFs reduce this risk by spreading exposure. If one company struggles, others can carry the weight. Diversification doesn't eliminate risk. Nothing does, but it manages it. It reduces the chance that one mistake, one headline, or one unpredictable event destroys your portfolio. Professionals care about that because professional investing is not about being right once. It's about staying alive long enough for the math to work. That's why professionals start with a different question than beginners. Beginners ask, how much can I make? Professionals ask, how much can I lose? Survival comes first, because if you suffer a huge loss early, a 50% drop, a devastating mistake, you don't just lose money, you lose time, you lose confidence, you change your behavior, you stop investing. And the biggest damage comes from what you do after the loss. ETFs help control risk without sacrificing long-term growth, which is why they're used everywhere in serious portfolios. Now, stock picking feels intelligent. It feels like you're doing something. You feel selective. You feel smart. You feel like you're building a personalized portfolio based on your knowledge. And occasionally, stock picking works. But here's the uncomfortable reality. Most stock pickers underperform the market over time, including very smart ones. Why? Because to outperform, you don't just need to pick good companies. You need to pick companies that do better than what everyone already expects. The market prices and expectations, and the companies everyone loves often already have perfection baked into the price. ETFs don't rely on being right about one company. They rely on something far more reliable: the overall growth of businesses. The power of owning the market is that you stop guessing who will win. You own the winners automatically. When industries change, the ETF adapts. Companies that grow become larger parts of the index. Companies that shrink become smaller parts, and sometimes get replaced entirely. You don't need to predict the future, you just need to participate in it. This is one of the most underrated ideas in investing. You don't need to find the needle if you can buy the haystack. Most beginners spend years trying to pick the next superstar company. Professionals often prefer to own broad exposure because it captures the collective progress of the economy: innovation, productivity, population growth, global commerce, and human advancement. That's the engine behind long-term market returns. Another reason professionals love ETFs is cost. Fees matter more than people realize. They're not dramatic, but they're relentless. High fees quietly drain returns year after year, and because investing compounds, fees compound too, in the worst direction. Paying extra fees doesn't just reduce your return today, it reduces the base that future returns grow on. Over decades, the difference can be enormous. ETFs are often low-cost, transparent, and efficient. Less friction means more compounding, and compounding is the whole game. This connects to the difference between active and passive investing. Active investing tries to beat the market. Passive investing tries to capture it. Most professionals understand a simple truth: beating the market consistently is extremely hard. Some can do it for a period of time, but doing it consistently across decades after fees, taxes, and competition is rare. Capturing market returns consistently, however, is powerful. And ETFs are built for that. This is why time and ETFs work so well together. ETFs shine over long periods because they reduce emotional decisions, smooth volatility, and reward patience. The longer you hold them, the less short-term noise matters. Day-to-day movement becomes irrelevant. Headlines lose their power. Your strategy becomes simpler. Keep investing, stay invested, let businesses grow, let time do the heavy lifting. ETFs also reduce behavioral mistakes, and this is more important than most people realize. Many investors don't fail because they picked the wrong assets. They fail because they behave badly under stress. They panic sell, they chase trends, they overtrade, they jump into hype when prices are high and abandon their plan when prices are low. ETFs protect investors from themselves because they reduce the temptation to micromanage. When you own a broad basket instead of one fragile story, it's easier to stay calm. It's easier to hold through volatility because you're not betting on one company's survival. Less choice often leads to better outcomes. Professionals don't need excitement. They don't invest for entertainment. They invest for results. ETFs don't create adrenaline. They create consistency. And consistency is what builds wealth. Professionals know that the goal is not to feel smart. The goal is to compound reliably. And compounding works best when friction is low. Low fees, low turnover, low taxes, low emotional interference. ETFs remove many of the obstacles that break compounding. If you're constantly trading, you increase taxes and costs and make more emotional decisions. If you're constantly changing strategies, you interrupt the compounding process. ETFs help you stay steady, and steadiness is what allows time to multiply your efforts. Another underrated advantage is scalability. ETFs work at every level, a small account or a large account. They don't require complex management. You don't need a team, a terminal, or a deep research department. You can build a diversified portfolio with a few ETFs and focus on the things that actually move the needle: saving rate, consistency, time horizon, and behavior. As your account grows, the same structure still works. That scalability is rare. Beginners sometimes think ETFs are too simple to be powerful. They assume that if something is simple, it must be weak, like it's only for people who don't understand investing. But in investing, simplicity is often a feature, not a flaw. Complexity often hides poor results. Complexity often sells a feeling. I'm doing something sophisticated. Professionals prefer what is repeatable, reliable, and efficient, especially when real money and real responsibility are involved. That's why ETFs are used everywhere. Retirement funds use them, institutional portfolios use them, endowments use them, financial advisors use them, not because they're trendy, but because they work. They provide diversified exposure, cost efficiency, and predictable behavior. They are tools designed for long-term wealth building, not short-term excitement. And it's important to understand this. Choosing ETFs is not settling for average. Some people think ETFs mean accepting mediocre returns, but average market returns over decades are extraordinary. Average in the stock market over long periods is not small, it's life-changing. ETFs give you access to that reality. They give you a seat on the long-term train of economic growth, and that train has historically moved forward despite wars, recessions, bubbles, and crashes. So when do ETFs make the most sense? ETFs are ideal when you want diversification, when you value time, when you want simplicity, when you want consistency, and when you don't want your success to depend on being right about one company or one prediction. They're especially powerful for beginners because they build good habits, investing regularly, holding long-term, and ignoring noise. And here's what ETFs don't require. They don't require constant monitoring. They don't require predictions. They don't require advanced knowledge. They require commitment and patience. They require you to respect the process and let time do what time does best. Final thought: professionals don't chase complexity. They chase reliability. ETFs aren't exciting. They're effective. And over time, effectiveness beats excitement every single time.